Many people complain about the job market, and at the same time, business owners complain about the quality of employees. So which one is right? Well, both. The reality is, business owners can only employ at the level of quality that is directly proportional to their turnover. And their turnover is affected not only by profit margin, but also by things like local fiscal policy. And in some countries, it's getting more and more expensive to have proper employees. The reality is, business organizational structures are shifting from having more lower level employees to having way more managers. This video, however, is dedicated to business owners and not employees. So if you are the latter, I suggest you go away and look for some fear-mongering YouTube channel that bashes on private equity firms. Let the big boys talk. Speaking of big boys, allow me to introduce myself. My name is Serena. I'm a business scaling strategist, and I help business owners make their companies ready for exit or acquisition. If you want to learn more about that, there's some links below. But for now, let's continue the video. Now, regarding how expensive employees are, there is a quick fix to this, and it is a very popular solution for startups. It's actually pretty cool to work for a startup. It's exciting, it's dynamic. Well, it can be really taxing as well. But more important for the subject of this video, it gives you access to equity in the company. So people can work for a startup and help build it for a year or two, and then they can go on their merry way and keep the stake that they have acquired in that company. Some people actually become millionaires in the process. This is what Steph, the founder, teaches employees. She has a cool Instagram account, constantly informing her followers on what new hot, sexy startups are hiring and have high potential for valuation growth. Because this is a type of value creation. It's actually a type of value creation that Tesla used to do before Elon Musk came in, buying 28% of the company back in 2004, thus becoming the majority stakeholder. Yes, Tesla was in fact not founded by Elon. He bought in. And if you want to be more like Elon, I suggest you start thinking like him. And I will help you with that. Dedicated to founders and business owners, I have wrote a book called Your Exit Strategy Blueprint, which covers most possible scenarios for partial exit or total exit of your company, either keeping control or losing control, or just full-on exiting. But today we will be talking about this specific situation in which employees get stake. So this scenario is called, I don't know if it's officially called like this, but I call it in the book Sweat Equity for Operations. And like I said, the perfect example of this is what Tesla was doing with the early engineering and operations team. So the structure of this is that early engineers and key hires received equity grants or stock options instead of high salaries to build the company's technology and operations. Typically, founders reserve between 5 and 20% of the entire shares, and they allocate this among key contributors over time, while founders retain majority ownership. The rationale behind this, for Tesla at least, is that they managed to conserve cash while aligning team incentives with company growth. They rewarded contribution and risk-taking in a high-growth startup. So the really valuable employees actually had skin in the game, more than just salaries and bonuses, which can be very expensive, because they could leave anytime they wanted with the stock options. So before Elon bought into Tesla, the mix of shareholders was like this. One of the founders had 40%, the other one had 15%, and the employees had a total of 15% spread among themselves and another 10% to investors. Here on my little pie chart, the dark gray are the founders, who obviously have majority stake and control, most voting rights, the highest voting rights. And then we have the employees here, and the investors have the smallest stake. This further incentivizes the engineers and the strategic employees because they also have voting rights for the company. It's theirs as well. Anyway, in 2004, Elon comes along and he buys 28%. Obviously, this is a private deal, so we don't really know who he bought from, like how much he bought from the founders, how much he bought from the employees, or from investors. We can hypothesize that the entire company valuation being 22.5 million, Elon put in like 7 or 8 million to get 28% of Tesla. That's insane. But engineers are not good business managers. Anyway, Elon had a majority of 28%, and the founders had 25 plus 25 each, separately. And the employees only had 5%, and the investors had 7%. So I think Elon bought from all over the place. Sweat equity is an example of equity for raising operational fund. Because if your business, in order for your business to achieve escape velocity, it has to go beyond the operational revenue that it's receiving. It needs some extra cash to put in that engine in order for it to escape the gravitational pull of planet Earth. Some other scenarios for these are equity dilution for working capital, in which the owner keeps control and the company needs funds to bridge financing cycles. And the owner, for this scenario, has to look for investors that commit when they clearly see a credible founder and they trust him, and a believable plan, and a path to getting their money back with an upside. Because investors take a huge risk, and in investments, risks have to be rewarded. Another famous example from the same year Elon bought into Tesla is, but this time for equity dilution for working capital, is the Facebook early seed, the angel rounds. And particularly, this is when Peter Thiel bought 15% of Facebook for $500,000, making him effectively own between 10 and 15% for $500,000, because the company at the time was valued at 3.5 to 5 million. I don't remember how Facebook looked at the time, but all I want to say is good job, Peter Thiel. In this case, the angels invest at this early stage for high risk and high upside potential, and the investors look for founder credibility, market potential, and clear use of funds for growth. You're not going to give him money without him explaining exactly how he plans to use it in order to make more money for you. Another scenario to get capital really fast is if you sell off equity and you also sell off convertible notes. So this means that you get some money fast and you don't instantly dilute yourself, because the investors will get some extra shares in the company, but it will be later and at a discount. This is used when companies need capital urgently and the valuation is still a little uncertain. And an example for this is, I don't know if you remember this, but they used to be the Y Combinator startups of 2009, 2010. The Y Combinator is a startup accelerator, and it provided seed funding, mentorship, and resources, very important, not just the money, to early stage startups in exchange for a small equity stake, typically around 7%. And companies like Airbnb and Dropbox and Reddit greatly benefited from this. So early investors receive convertible notes, giving them the right to convert to equity in a future price round, which is great because they're going to be worth more because they just got an influx of capital and, hopefully business grows. That's why we do business in the first place. And it's a minimal immediate dilution because the actual dilution occurs later at Series A or Series B rounds when the notes get converted. In this case, it allowed Airbnb to raise capital to expand operations without setting a valuation too early. And it deferred dilution until the company was more valuable and less risky. So, to show you the graph, the ownership is usually undisclosed because we don't know what they did with the business, who invested in it and stuff. It's private. And then immediately the ownership stays the same because the investors got convertible notes. But later on, when the notes convert, the original ownership dilutes to 93%. It's really cool for fast cash and slow payout. It's nice for everybody in the startup scene. These have been only some examples of selling equity in order to ensure excess capital for operations to make the company grow even faster. If you like the entire book, with all scenarios and blueprints and detailed phases and deliverables for each phase of partial or total exit, there are some links down below. And thank you for watching. Bye.